Welcome. I'm Mark Kennedy, Director of the Wahba Institute for Strategic Competition here at the Wilson Center, what we refer to as WISC. We're thrilled to have everybody here in person and online. We're also honored to have our Chairman, Sadiq Wahba, with us here today. We at WISC believe in American economic leadership, American economic diplomacy, and that a key piece of that is helping to activate more private investment in international infrastructure. That is why we formed 3 different working groups to look at how we could mobilize more private infrastructure investment around the world. One of those was comprised of leaders in private capital. Another was comprised of lawyers with development finance experience, and another was corporate leaders. And they have each come together with their own set of recommendations as to what we can do, what the government can do to help spur more private investment in international infrastructure. I'm very appreciative of all the hard work that they have done, and I am also looking forward to the insights that we will gain listening to them here today. We're thrilled to have Nisha Biswal, the Deputy CEO of the Development Finance Corp, kick us off today. But to begin things, I'm thrilled that we have with us our president of the Wilson Center, Ambassador Mark Green. Ambassador Mark Green brings a wide range of experiences to his post, whether it be being a congressman, ambassador to Tanzania, director of the U.S. Aid Organization. We're thrilled with his leadership. We're thrilled he could be here today. I give you Ambassador Mark Green, president of the Wilson Center.
Thank you, Mark. And Mark and I served in our deep, dark past together in Congress. We don't talk about that very often, given all that's going on. Now, in all seriousness, Mark, thank you. Thank you for kicking us off, but more importantly, thanks for the work that you're doing. It's fabulous, doing some important rethinking, I think, of American tools of economic diplomacy. So, as many of you know, we're a unique institution in the foreign policy landscape. We're congressionally chartered. We're scholarship-driven, and we're fiercely nonpartisan and independent. I always argue that that special status that we have creates special obligations to not duplicate what others are doing, but instead to focus on the most important, to focus on those openings, issues, and opportunities where we have something that we can add, where we can help to make a difference. And that's really why we're all here today, because mobilizing American private enterprise and investment matters like never before. In my days at USAID, I argued that the purpose of our development tools and initiatives must be ending their need to exist, that we should walk with countries on their journey to self-reliance, that private enterprise is the most powerful force on earth for lifting lives and building communities, that American global leadership means harnessing the might of private enterprise to help countries go from being aid recipients to development partners, and in a perfect world, fellow donors and investors. For many years, we fell short in advancing that vision because we lacked the kinds of development finance tools that could extend the power of the private sector to critical projects and places. A more flexible MCC and XM, and more recently the U.S. Development Finance Corporation, have been huge steps in the right direction. But in this competitive world where alternative models of assistance are emerging continuously, models that can eventually cripple countries with overwhelming debt and rob their young people of the full value of their natural resources, well, with those models emerging, we need to do much, much more to make our tools stronger than ever before. And that's the work that WISC has been undertaking. Adjusting for economic scale, the U.S. falls behind our counterparts in Europe and Japan in terms of providing financing for international infrastructure, and we're lagging even more compared to China. The good news is that Americans are almost always the preferred partners when it comes to building infrastructure and creating those sustainable jobs. I saw that in my days in Tanzania, in my years on the MCC board, and in my role as an original board member of the DFC. When countries turned to authoritarian partners, it was almost always because there wasn't an available U.S. alternative. As the leaders of those countries, the ones reluctantly turning to China, put it, they did so because we weren't there. That's why this line of work, the line that Mark Kennedy and WISC has been leading, that's why it's so important. Being there, being responsive, bringing the power of private enterprise to where it can make the greatest difference, where it can accelerate that journey to self-reliance. As Mark said, last spring, WISC launched 3 working groups centered around the business, legal, and financial communities to pool their experience and insight into how to unlock private sector investment for international infrastructure. From their thoughtful conversations, we recently released a series of one-pagers outlining their recommendations, and we're honored to be hosting today members from those working groups, as well as representatives from the administration and Capitol Hill to discuss the policy implications of those recommendations. And I can tell you in just the initial conversations we've had on the Hill, there is a great appetite to take these tools up and to strengthen them and to deploy them like never before. But first, it's my honor to welcome Nisha Biswal. She is the DFC's Deputy CEO, and she brings over 30 years of experience in U.S. foreign policy and international development programs. Among other things, she served as Vice President for International Strategy and Global Initiatives at the U.S. Chamber. She oversaw the U.S.-India Business Council and the U.S.-Bangladesh Business Council. She served as Assistant Secretary for South and Central Asian Affairs at the State Department from 2013 to 2017. Nisha, we are delighted to have you today. We're honored to have you today, and thank you for what you do.
Well, hi, good afternoon, everyone. Such a pleasure to be here at the Wilson Center. Can you hear me properly? Let me make sure this is there. Such a pleasure to be here at the Wilson Center at the Wahba Institute for Strategic Competition. I want to thank Mark for that generous introduction, and he and I also had in common our tenure at USAID in our careers. He has had a long and distinguished career in advancing U.S. foreign policy and a development agenda that is rooted in our values and interests. I also want to thank Mark Kennedy and Sadiq Wahba for the work that they're doing in this town to shape the discourse around the geoeconomic competition that is playing out globally through the research and the scholarship of the Wahba Institute. As DFC's first deputy CEO, I am fairly new to the organization. I think I have 3 months on the job. And DFC itself is new to the development finance scene, though our predecessor, OPIC, was certainly around for many decades before that. But as DFC comes into its 5th year on the scene, let me just say it is an impressive track record that we've been able to initiate over these past 4 years. And for that, I want to first commend all of the people who played a role in creating and passing the BUILD Act, which in turn established DFC, not the least of which, of course, was Mark Green for the role he played both in the inception and then on the board. In passing the BUILD Act, Congress filled a critical gap in our national security and economic toolkit. In addition to providing the expanded authorities and doubling our total exposure cap from the $30 billion of the OPIC days to $60 billion for DFC, Congress also provided us with a dual mandate to advance both the development impact and the U.S. foreign policy interest. And I'm going to get back to that dual mandate and its importance in a minute. But let me just first share a few key data points and some good news. I mean, in an age of increasing polarization, DFC represents what we can achieve through bipartisan collaboration and compromise. which is a world-class development finance institution that is rapidly scaling and investing around the world. And I know you're going to hear from a number of private sector players in the next panel, all of whom, by the way, are partners of DFC in various projects around the world. But in 2023, we unleashed and committed over $9.3 billion to be exact, in financing, with a total global exposure now for DFC of $42 billion. So we've exceeded the limit, the cap that OPIC had. We're now at $42 billion in global exposure across 111 countries. $10 billion of that total exposure is in sub-Saharan Africa. $9.5 billion in Latin America and the Caribbean, and an increasing focus on the Indo-Pacific with $9.3 billion and climbing. We are mobilizing finance to solve global challenges. In FY23, $2.5 billion went towards 2X investments in gender and inclusion, for a total exposure of $10 billion towards 2X financing. Our climate financing, which was an impressive $2.3 billion in FY22, saw some eye-popping growth in 23, which we will announce as we get closer to COP. We have mobilized over $1 billion in food security. But it's important to look beyond the numbers, beyond the regions, and think about what we're doing, how we're doing it, and why we're doing it. And since today's conference is focused on global infrastructure, let me note that our CEO, Scott Nathan, as he came to DFC, identified that need for financing for high-quality infrastructure, both physical infrastructure and 21st century digital infrastructure, as a key priority for the organization. And so we have seen a scale-up in the investment of airports, seaports, transportation networks, and trusted and secure ICT networks as a clear and compelling way for us to meet our dual mandate from Congress to drive developmental impact and to advance our foreign policy priorities. And we're using our full suite of tools, including equity investments, political risk insurance, loans and loan guarantees, and technical assistance to invest in a series of high-quality infrastructure projects that help connect communities to the opportunities of the global marketplace. So let me bring this back to the importance of our dual mandate and how I think about the strategic competition lens through which WISC is approaching that issue. Many worry that the development impact part of our mandate comes at the expense of a strategic investment or a strategic lens, or that the strategic, or conversely, that the strategic deals are not demonstrating sufficient development impact. But in our experience, the dual mandate is one of the things that sets us apart from our competitors. It's our commitment to ensuring transparency, high standards, commercial viability, as well as attention to labor, human rights, environmental and social impacts that ensures that DFC is not investing in white elephant projects that yield poor economic outcomes and lend themselves to mounting unsustainable sovereign debt around the world. We want to work with our clients to ensure that these projects are boosting economic impact and development outcomes. So when we financed a solar manufacturing facility in India to help diversify the solar supply chain, we didn't just stop there. We worked with the client to ensure that a commitment to hire women was boosted so that 60% of the workforce for this facility, including technical and management jobs, will go to women at a time when India's participation of women in the workforce fell to abysmal 19% due to the pandemic. When we financed an expansion of a graphite mine in Mozambique, where the offtake will support electric vehicle battery factory in the United States, we didn't stop there. We supported the building of a graphite processing facility in Mozambique to create more jobs and drive greater economic growth. Because we agree with the African leaders who tell us that investments in critical minerals can no longer just be extractive and exploitative. That they want investment that is going to create value addition, create processing capabilities, and build economic opportunities for their people. We're not doing this work alone. DFC is the U.S. government's key implementer in the Partnership for Global Infrastructure and Investment, PGI, a framework which was launched by President Biden and G7 leaders last year to coordinate our efforts to mobilize hundreds of billions of dollars in infrastructure financing around the world. And just yesterday, I was with leadership from the European Commission and the European Investment Bank talking about the importance of partnership and discussing how we can harmonize our standards and our processes and better leverage DFI financing to make it easier for our clients to access financing across multiple DFIs and do more co-investment. This coordinated and scaled approach in partnership with the private sector and our host countries is driving up the strategic competition for development dollars in the marketplace. This is no longer a race to the bottom. Instead, we are driving up the quality, the transparency, and the sustainability of these transformative projects. We are raising the bar every day. And we are de-risking for the private sector to be able to invest with greater confidence in markets where they might perhaps be hesitant. DFC is determined to change the face of infrastructure development, and over the past 3 years, we have begun to make some real progress. We invested $150 million to modernize an airport in Sierra Leone and a similar amount to modernize a seaport in Ecuador. I think Scott was just in Sri Lanka and in Greece last week announcing a port facility in Greece and a container port facility in Sri Lanka. We have committed $300 million to support the construction of data centers in Africa to expand digital access, inclusion, improve digital performance and cybersecurity, and bolster trusted equipment and networks in a key region. And because DFC only finances private sector projects, we're not saddling governments with additional debt. In fact, through innovative debt for impact swaps, we're helping countries to restructure unsustainable debt, like the project in Ecuador where we worked with Goldman Sachs and others. DFC provided political risk insurance to support the largest debt for nature swap in history. We've been able to accomplish all of this under the current authorities of the BUILD Act. But as many of you know, the DFC's authorization runs out in 2025. As we approach reauthorization, we're eager to think through where we have succeeded and where we can do better. And as we engage in these conversations, we're very eager to hear from all of you, and particularly through partnerships like the Wilson Center. And that's why conferences like this one and the working groups that you are convening are so helpful for a new and growing organization like DFC to help, one, keep us on our toes, and two, provide us with some of the critical insight into where you see opportunities, where you see areas for improvement and ability to grow. As the Wahba Institute's report makes clear, to advance development and meet the challenge of strategic competition, the United States can and must do more to leverage the power of the private sector. That requires DFC to continue to grow our capacity and our ability to drive and measure our impact. But it also requires committed partners, like many of you in the room, who understand our mission, who understand the stakes of getting this right, and who bring to us the clear and compelling projects that can leverage our financing and our impact. We want you to bring us your ideas. We want you to bring us your opportunities. And we want to be able to deploy our tools in creative and innovative ways to create the greatest impact. So as we move forward in the coming year, we look forward to having opportunities to hear from you, to engage in consultations with key stakeholders, and to think about what it is that the United States wants to put out in the global marketplace. It is a strategic competition, but one that should be defined in our terms, and that is a competition for impact, a competition that meets the high standards and the best practices that we know that our clients demand and that our partners in the developing world deserve. So with that, thank you very much for giving me this opportunity to be with you today, and I look forward to hearing about the outcomes of this conference. Thank you.
Thank you so much, Ms. Biswell, for your leadership of and commitment to the DFC and the vital and promoting the vital role that the DFC plays in mobilizing private U.S. capital in meeting the global challenges and coming up with solutions for borderless issues for which U.S. leadership and U.S. private capital is critical. I would now like to invite speakers for our first panel, De-risking to Activate Private Capital, to join us on the stage right now. The moderator will be Michael Kumar, Managing Director and Global Head of Project for Commodity and Infrastructure Finance at Morgan Stanley. Peter Corsell, who is a partner for Global Infratech Fund at I2 Capital, as well as John Greenwood, who is the co-head of Structured Finance Americas and co-head of Latin America and head of Latin America investment banking at Goldman Sachs. So, gentlemen.
So thank you very much for all of your time. Let me just kick off by saying, what is the premise of this conversation? And the premise of the conversation, I think, is relatively straightforward. It's often talked about how much capital is available in the world, the trillions of dollars that is available to be invested versus what actually gets deployed, particularly in emerging markets. And really, what are the barriers that prevent that capital from flowing where it's most needed? What can we all do, and what can institutions do to unlock this capital? And there are as part of our working group, we thought about a lot of things, and we came up with some recommendations. But I think it's better to just frame the conversation and go through what our thought process was and how we came up with some of the recommendations. So before I go with that, maybe we could start more from a macro and a policy perspective, and I'll be. Not to put Shikoko on the spot, but maybe I'll go with Shikoko first. So a couple of questions. In particular, your focus is on Asia. And before we talk about what steps governments or regulators or the private sector can do, what are the dynamics in Asia today, and how do you see the need for greater infrastructure investments amongst the emerging nations in that region? So what are the macroeconomic drivers and needs coming out of Asia today?
Yeah. So Thank you so much. And the title of this panel, of course, is focused on de-risking. And de-risking is a word that's been bandied about particularly this week in the U.S.-China competition context, given that we've just come out of a bilateral between Xi Jinping and President Biden. But of course, we have to bear in mind that these two men are gathered for the APEC forum, which actually consists of 21 member countries. It's not just about the United States and China. And APEC, bear in mind, is the Asia-Pacific Economic Cooperation Forum. And their focus should be and will be about what the needs are for the Indo-Pacific to remain the most vibrant region in the world, and how to expand and upgrade infrastructure to be part of that goal of realizing their economic vision is going to be part and parcel of that conversation as well. So if we look back a decade ago, China launched the BRI, the Belt and Road Initiative, to integrate and invest in the large swath of the world, expanding all across Asia and beyond, going across the Middle East to Africa and even into continental Europe. 3 years after that, China launched the AIIB, the Asia Infrastructure Investment Bank, which was seen as an instrument to further the goals of the BRI. And there had been a great deal of debate about what role AIIB would play. And to this day, though, the United States as well as Japan are one of the handful of countries that are not part of AIIB. And in fact, key US partners and allies, including Britain, France, Germany, had joined the AIIB from the offset. And there had been a great deal of debate in 2016 about whether the Obama administration should actually join the AIIB too or not. Of course, in today's political climate, that kind of conversation is moot. The strategic rivalry between the United States and China has only increased, and it's not going to look back. But we do know that there has never been a question about the need for infrastructure investment, especially in higher risk, lower income countries. And we know that UNCTAD, the UN Conference on Trade and Development, estimates there's a need of about 2.6 trillion in infrastructure investment each year until 2030 to meet the Sustainable Development Goals and also meet the net zero goals by 2050. The World Bank is now focused on creating a livable planet, and it links climate action with poverty alleviation. But at the same time, we have to bear in mind that there's growing wariness in emerging markets about growing protectionism, the rise of industrial policy, in the name of resilience in countries, in many countries across the world, including here in the United States. Infrastructure investment should be part and must be part of sustainable growth worldwide. And certainly infrastructure investment in Asia focuses on sustainability. But it's also an opportunity to look into supply chain resilience and also move up the supply chain ladder as well, so that countries are able to avoid the middle income trap. And so we cannot move forward without increased investment in infrastructure and infrastructure across the board. And the private sector really does play a critical role, not just in providing much needed capital, but also spurring innovation, capacity working. And so there is more need in a wide range of areas across the world, and especially in the Indo-Pacific.
Shikara, thank you very much for that opening commentary, which I think paves the ground for a more fulsome discussion. I think you touched on it, and that's obviously the name of the panel, which is de-risking. One of the major risks that I often hear about when I deal with my peer institutions, my own institution, and with clients of ours who are making investments in emerging markets is currency risk. Because at the end of the day, if you think about it, and I'm going to paint this a very broad brush, most institutions worldwide who have capital and can deploy capital are either in dollars, in euro, or in yen. Very, very few emerging market countries operate in those currencies. And even when they do operate sometimes in what I would say dollarized economies, there's still underlying issues with the local currency. So when we're dealing with lending or investing in international currencies but are exposed to emerging market currencies, one of the major issues that comes up is how do you mitigate the currency exposures and the currency risks? Peter, maybe I could ask you to comment on, because in our previous dialogue, you felt very strongly about this and you had some very good ideas. So maybe some thoughts from you on currency exposures.
That's an excellent point, and very kind of you to say. Michael, I do think the local currency volatility question is a key inhibitor, and I think it's really all about encouraging local liquidity denominated in local currencies. into these infrastructure projects. And there are a few approaches. One would be funding and risk participation agreements with local institutions denominated in local currencies, so that you have more of a shared risk and shared investment paradigm that brings local currency into the project from the beginning. Having MDBs and DFIs help countries develop programs that offer a currency swap from the government is I think another approach that would be effective. And then, just basically MDBs and DFIs issuing greater local currency bonds, larger and more bonds denominated in local currencies to enable them to de-risk these projects through increased local currency lending. So I think it's really just all about diversifying the currency base in these projects, so you avoid the trap that you described.
No, those are excellent points, Peter. And I'm personally reminded of a transaction that a nameless gentleman in this room and I worked on years ago in Chile, where at the time this was for an infrastructure project or for a road, which is obviously going to be, it was a toll road. And obviously it's going to be paid for in local currency, but they needed, Chile at the time, even though they had a robust pension system, needed to attract foreign capital. And the Chilean government undertook an interesting idea, which was the Chilean government provided the currency swap because they believed at the time they could best manage the foreign exchange exposures as a country. So I'm not saying that's the only way to do it, but there are things that need to be considered in some of these emerging markets that could follow that model. Mexico is another example where the local markets have developed sufficiently that you can fund a lot of the infrastructure projects locally. With that, let me segue, John, to you, and maybe just lay out the question of, we're all aware that there has been authorization granted for 100% debt guarantees from various developmental financial institutions, but they tend to still operate in that 80-20 mode. John, maybe with your experience, because I know you have a lot of experience, particularly in Latin America with DFIs, maybe you could make the argument why 100, why not 80? What's the logic, and how do you think that would help unlock capital?
Yeah. So one of the key issues that we're facing today with a 20-year historically high interest rates has been capital outflows out of the emerging markets, and the impact of the flight to quality, and ultimately blended finance becomes just even more important. And when you actually look at blended finance volumes over the last year, in 2022, according to the International Energy Agency, blended finance has actually declined deal volumes by 45% in the last year. And so we're actually going, this is the time in which we actually need to increase volume in blended finance when there are constraints in the private sector. And so one of the things that has obviously been around for a long time is within the blended finance is bringing in private sector capital with the support of development finance institutions, multilaterals, and export credit agencies. And there's always been this question, this debate when blending the two is, should there be 100% guarantee or should it be something less like 80%? With the concern being, if there's 100% guarantee, is there truly skin in the game, and are incentives truly aligned? And if they aren't, does that ultimately lead to higher non-performing loans for the development finance institution? And I guess in terms of the arguments, and certainly we've seen a lot of examples of this. I would start with, and we just heard from the deputy CEO of the Development Finance Corporation. If you just look at the track record of the DFC, and they mentioned $42 billion of loans deployed, and you look at the underwriting standards and non-performing loans, DFC provides back to the U.S. taxpayer something over $250 million a year. And so if you look at the underwriting standards and you look at the non-performing loss rates, it's actually quite low. And where is the skin in the game? Where is the risk sharing? It's not within the cap stack of debt, but it's through the equity. And typically in these infrastructure projects in developing countries, equity would typically be anywhere from 20 to 30% of the total project. And that's truly where you have incentives aligned. In fact, it's the equity in these projects that's really defining the development of these projects, the ongoing operations of the projects. They're the ones that are really the management making those decisions, and so that becomes critically important. I would also say that the friction costs created by trying to reduce the guarantee amount below 100% is significantly, particularly when you're trying to bring in institutional capital. So if you're a money manager at an institutional investor, and you're trying to bifurcate, high risk emerging market risk with 100% guarantee, it's very difficult to have that into a single fund. Number one. Number two, if you look at credit ratings, also difficult, unless it's a first loss, subordinated loss, to get the benefit of the guarantee. And finally, around pricing, there have been a number of examples of partially guaranteed structures that have been issued in the market. And if you look at it, there's pricing friction that ultimately increases the overall cost of capital between the two. In many instances where we've seen partial credit guarantees, in the financial markets, we'll try to bifurcate that by splitting the risks into two. But again, that ultimately creates increased cost of capital. And again, the point of blended finance is to crowd in more private capital at a reduced cost.
Thanks, John. I think that's a great segue, Chicago, to go back to you and talk about a little bit about collaboration between DFIs. There's been a greater effort by both the G7 and the Quad to coordinate action in supporting international infrastructure investment. In your opinion, why is this important, and how anxious are Asian partners to collaborate? Because at times we see various DFIs, I hesitate to use the word almost competing.
Right. In a nutshell, I would say it would be a seal of good housekeeping. There is, as I said at the beginning, AIIB is there, and it's hugely present. The United States' goal is never to match China's investments dollar to yuan, but rather it is to ensure that there is that movement by the public sector so that the private capital would follow suit. And this is where I would really ask you to see if that is indeed the case. But I would say that it is imperative for international financial institutions to go into countries. And one other thing I do want to point out is that, for instance, in Asia, there's a great deal of excitement about investing in Southeast Asia, of which there are 10 countries. But not all 10 countries are seeing that capital in equal amounts. So the most attractive countries are countries like Vietnam and Thailand and the Philippines. It's not going to Cambodia. Cambodians would argue that they are moving forward with some kind of reform and trying to meet global lending standards more at a higher level than before, if they compare themselves to their own past. These are arguments that we will be seeing much more from emerging markets, but having that presence of international financial institutions does actually hopefully allow private capital to follow suit. And I would ask if that is indeed the case.
Peter?
I absolutely agree, and I'm quite taken with this idea of MDBs acting as originators versus ultimate funders, because there's a great amplification effect, right, that can occur if MDBs act in that capacity. I mean, MDBs could activate more private capital by selling off a portion of the loans they originate rather than holding the full loan until maturity. The IFC, the Inter-American Development Bank, and others could issue more B loans to the market while retaining control of the A loans. And, so meaning once a institution originates a loan, it remains the holder of record, but it syndicates lower tier of the loan to the market. And this, of course, would give great comfort to private capital investors, because they would know that a counterparty, an infrastructure project, could not default on that loan without simultaneously defaulting against a multilateral development bank. So you have this kind of big brother effect that would occur. You could bring in lots of capital below and amplify the MDB's work. And I think that would be one good approach.
And Peter, maybe just to compliment, because you referenced the AB loan, which obviously has been around for some time with the Inter-American Development Bank, the IFC, amongst others. And I do think it's an important way in terms of, blended finance and bringing in private capital. I would say that there are a number of constraints, I think, that still exist that are needed to be addressed as we think about enhancing those. I think one is from a regulatory capital perspective, it's not clear, and I think it's treated differently in many banks and other institutions, whether having a umbrella support from the A loan actually gives you regulatory capital relief. I think it's treated differently at different places. Two, because the development finance or the multilateral is the lender of record, they have limitations with respect to further secondary sales of the B loan, afterwards. And for financial markets, liquidity is incredibly important, and having constraints on who you can ultimately sell the loan or bond to can create complexities, particularly for institutional investors. And so I think that many of these things are looking to be addressed. And I would, give a recent example of what we're seeing is that maybe instead of purely in the AB loan, where a development bank or a multilateral can actually participate as an anchor in an existing bond issuance, and that can actually provide some liquidity if they can ultimately be both a buyer and seller of the paper directly as a creditor. And so I think there are a number of things that are being discussed to be able to further accelerate kind of the blended finance and the participation of private investors in these structures.
Thanks, John. That's a great point. It's also, and I'm glad you touched on the issue of regulation, because if you look at it broadly, there are three sources of private capital for emerging markets. There are regulated institutions. By that I mean, broadly speaking, banks. They are corporates who are making strategic investments, and then they are funds, broadly speaking, institutional investors like I Squared Capital. One of the most prevalent sources of capital is banks, whether they're U.S. banks, European banks, Asian banks. Do you think it would be helpful? And let's just talk about the U.S. for a moment, because that's where we reside, and we're both belong to U.S. institutions. What do you think the Federal Reserve or the OCC can do to help unlock capital flows from U.S. banking institutions into emerging markets?
So I'll just start. I'm sure you have your own views, Michael, in terms of the current regulatory environment and what can be done. But again, I think as we think through also the upcoming Basel III implications and risk capital, I think, to me, one thing would just be clarity in the regulation in terms of risk capital treatment for loans and other types of exposures that are supported by multilaterals and DFCs. And so certainly in the context of, it might be clearer when there is 100% guarantee of a AAA entity. But if you're looking at, as I mentioned before, if it's an umbrella support or just political risk insurance, or there are some limitations with respect to the payout under the guarantee, I don't think there's a lot of clarity under the existing risk capital charges. I think there are a number of other things, too, that can be, clarified in terms of with the multilateral support, getting preferential risk capital treatment under the regulations.
No, I completely agree. And look, again, without even getting into my views, I mean, just from a fact-based perspective, the ECB provides favorable regulatory treatment to European banks for infrastructure loans in Europe, and it's quantitatively verified that the cost of debt financing in Europe is lower than the U.S. for infrastructure projects for that simple reason. So again, I don't think that any of this is going to happen overnight because regulators are independent, but there are little things that can be done, I think, as we work our way through this process. Maybe I'll go back to you, Peter, just to talk a little bit about, and John, please jump in. Tenor of financing. Banks tend to lend for about 7 years. Most infrastructure projects are 20 plus years. So maybe your thoughts about what can be done to increase tenor of lending rather than burden projects and countries with refinancing risk. And then also a little bit about, how how funds, meaning institutional funds, can become more active in emerging markets.
You want to start?
Sure, I can get started. That's absolutely correct. So when you think about the infrastructure as an asset class specifically, obviously these are assets that have long useful lives and therefore long duration. And typically you want to match your assets and liabilities and have long duration debt, against these assets. And that has always been a constraint for commercial banks and has actually become even more a constraint. If you look back, 15 years ago, you'd find U.S. banks, European banks, Japanese banks able to lend out 15 to 20 years plus for infrastructure in emerging markets. And as Michael had just referenced, that has now significantly been shortened due to some of the regulatory capital, other issues that we've talked about, to 5 to 7 years. And so it's very difficult to finance a 30, 40-year asset with 5 to 7 year debt. And so, Michael, your point in terms of institutional investors and multilaterals and blended finance all really converge around this topic of tenor. And so one thing that we've seen and we've worked in most of our transactions in emerging markets is that when we bring together commercial banks and development finance institutions, oftentimes what we'll do is we'll have two different tranches, with the commercial debt being a shorter dated tranche, with the multilateral debt being longer dated and having a very long grace period of principal, such that you allow the cash flows first to de-risk and repay the commercial bank, and have the multilaterals have much longer duration debt. But another thing, I think, to really drive capital into infrastructure in emerging markets, we need much more than just what the multilaterals can do, and it's incredibly important that we get more institutional investors, because again, it makes a lot more sense for pension funds, insurance companies, again, to provide longer duration, credit. And so a number of things that we've looked to do in order to increase the participation of institutional investors in infrastructure in emerging markets is to try to address some of the risk challenges that they have in investing. So for an example, Peter talked about currency issues. Several funds cannot invest in local currency, and so having ways that we embed swaps or other things that can get it back into hard currency is one. But another one that's important is sometimes it's difficult for an institutional investor to be able to undertake the diligence, everything that's necessary to understand the construction risk for large projects. And so oftentimes what we've done to bring in larger passive money managers is to have the multilaterals providing protection over the construction risk. That can be done through a full guarantee over the construction, or even things like subordinated liquidity facilities. Oftentimes when we think about infrastructure, we don't think about if it's going to be built. It's just going to be when and at what cost. And so if you had a subordinated liquidity line that was provided by a multilateral, that would certainly help in terms of the rest of the credit to bring in a larger cross-section of institutional investors.
And I would only add to that, obviously increased clarity and stability in the regulatory environment over a long tenor, it matters even more. And it would be helpful if we standardized MDB and DFI assets and adopted more of a common market-based credit risk rating. I think that would be very helpful and would facilitate securing them and selling them to a broader pool of investors, and sort of encourage the liquidity that you were talking about earlier.
No, and to that point, I think there has been some streamlining amongst the MDBs and the DFIs, but I think the next level would be, for example, each MDB and DFI, if they're jointly lending or investing to a project, shouldn't require their own environmental assessment. Yeah. They should be able to share, documents, best practices, I think, which will cut costs and streamline the processes even more.
I think this point that Peter raises is an important one in terms of, is there a way to standardize the MBD loans in a way that you could ultimately pull them together and create diversification, and ultimately then package them together and sell them like through a CLO structure. I think for those of us who have spent decades in emerging market infrastructure, that truly is the holy grail. because we do suffer from every single project being so bespoke, the structure being very, very bespoke, and the ability to put those together has always been challenging. And so any way that we can further standardize to support that kind of securitization of loans would be important.
No, you're right. I mean, and at some point, with the DFCs and MDBs, like recycling their capital rather than, having them wait for 10, 15 years to get their capital paid out so they can redeploy it, I think is very important. I've just been given a hint that we're approaching the end of our session. But before I close out, I've asked a bunch of questions to my distinguished panelists. Is there any question that I should have asked that I have not? So I'll open it up to the three of you, and then we can conclude.
Well, as an infrastructure technology investor, the role of enhancing and disruptive technologies in these new infrastructure projects. I was just at the AIIB actually last week in Beijing, and they really did emphasize the role of taking a technology-first approach to a lot of the new projects. I think that could be an interesting topic for a future conversation.
Absolutely.
For me, it's how do you select not just what's bankable, but what is actually going to be profitable and sustainable as well. And that includes looking at the region and the country in particular. And I would like to know how those risks assessments have changed in light of geopolitical competition, in light of technological changes, and in light of the different priorities that the Bretton Woods institutions themselves are now focusing on as well.
I would put my question around energy transition. It's often quoted that in order to meet the 2050 net zero goals, there's $6 to $7 trillion needed invested into emerging markets, and I think we're barely reaching $1 trillion a year. And so the key question is, what specifically can we do to accelerate blended finance, private and public sector, around energy transition, specifically targeted at in the emerging markets? And there's a lot of innovation that's being discussed right now, but what role will multilaterals have? What role will certain financial products like voluntary carbon credits, et cetera, have in supporting greater energy transition? And specifically, as we think about in Asia, where there are a lot of new coal-fired power plants, how can also both multilaterals and the private sector support the responsible decommissioning of coal-fired power plants and bringing in more alternative energy.
Perfect. Well, thank you very much for this interesting discussion. Mark, I'll turn it over to you.
Thank you so much.
Well, let's give our panel one more round of applause. Thank you for those great insights. Thank you. And the next panel can start working their way up here. I very much appreciate those insights. I know not everybody might be familiar with Basel III or AB loans or liquidity or tenure or all those. We'll make sure we define those in a follow-up or report we're going to be doing. But I think it's important to note, unless we get people from these organizations and that institutional capital above that 1 trillion into the 5-6 trillion that was just mentioned, we're not going to be able to address the issues we have. So you will see us at the Wahba Institute for Strategic Competition continuing to work on how do we activate institutional capital more significantly towards infrastructure in developing markets. Our next panel can come up as we get here in just a second, but when we think about the challenge ahead of us, part of the way we're trying to address that is that the Biden administration has launched with our G7, our group of 7 partners last year, a program called the Partnership for Global Infrastructure. And that is meant to have U.S., Japan, Europe, and others come together to help address some of the bigger issues out there. A couple of ways they've done this. One of those is the Libido Corridor that combines a focus on the transportation infrastructure with the port, the infrastructure, but along with it, things like digital and other means. But it also includes things like JETPs, Just Energy Transition Partnerships. So there's many ways it can be done, and to try to unpack what is the administration doing with our partners and how can we make that more significant. I'm pleased that we have Marie Lamfrendo as the leader of that panel. Marie Lamfrendo leads the Global Infrastructure Partnership, which is a creation of the G20. She is sought after as an advisor on infrastructure globally by ministers around the world, has just come to us from APEC, from the Asian Economic Partnership Cooperation. We're pleased to have you here, Marie. I'll turn it over to you to introduce the panel and to have this discussion. Thank you.
Thank you very much, Mark. Good afternoon, everyone. So very pleased to be with you today, and very big thank you to the Wilson Center, but also to the Wahba Institute for Strategic Competition for hosting this important discussion today, and for all the work that you're doing. I think you've heard this from various people today, but I think it's quite outstanding to have both the content and the level of engagement for the work that you're doing. So very much thank you for that. So as you said, I was just at the APEC Finance Ministers meeting at the invitation of Secretary Yellen to provide an overview of the work that we're doing on infrastructure at the G20, but in the lens of what Secretary Yellen is articulating around modern supply-side economics. And I think it's very relevant to our discussion today, because that agenda of President Biden is really around, to unlock the private sector, you will need targeted government intervention. And I think that is really what is bringing home that kind of modern supply-side economics, as opposed to the one that was from the Reagan era. So I think that into the discussion that we had during that conversation with the ministers, it was very much that infrastructure is one of those 5 pillars, but of modern supply-side economics that include labor, that also include R&D, so lots of things that we've discussed in the former panel. But infrastructure is really contributing to those pillars, and at the same time, those pillars also contribute to infrastructure. So all of this works really into a system, if you want, that we need to crack, and it's not very much an easy one. So, and I think also we back to that discussion through that modern supply-side economics, that this has to be a partnership. It has to be a partnership, and that requires very close, open, transparent communication and collaboration to identify, but define and also scale up the right solution to enable the economic, the social, but also the environmental potential that infrastructure should provide to our economies. So in this context, the US and its G7 partners have committed to a partnership for global infrastructure, also called PGI. Used to be called PGI, but has been renamed PGI, and we'll hear more about that in an instant. This has included joint efforts like investing in transportation and railways and ports, ensuring secure and trusted and open RAN communication, and developing resilient critical infrastructure supply chain. So how can this PGI best advance those priorities? We've heard from the Deputy CEO of DFC that they obviously are working as a key partner of PGI, but PGI is more than just DFC. It's also more than just the US. So very keen to understand how that kind of global initiative could help facilitate some of the solutions to bring more private sector investment in infrastructure. And I think the first panel brought us a lot home in terms of what is still very needed on the ground. And we will have today, panelists coming from, of course, PGI and also the Wilson Center. I will also probably put my hat as a former equity investor and throw some potential difficult question in the mix. So very much I look forward to the discussion that we're going to have today, and that first of all, we'll hopefully clarify what PGI is and does, but also very keen to hear from colleagues at the Wilson Center more around what's happening globally and how do all of those efforts collaborate together, because I think it's important to realize that there is a lot happening, and part of my role is to follow that and advise the minister on that, but think that if you are in the private sector and are trying to tap in that expertise, where do you find it, right? So I think that on that note, I will probably let each of you introduce yourself, and very briefly telling what you do. We will get into the detail of PGI and what you're expecting from the panel and the discussion today. You want to start, Denny?
Sure. Hi, I'm Denai Pauly. I'm a senior advisor with the PGI team at the State Department, where I lead globally our gender, agriculture, and health portfolio, and then I also lead our libido corridor work.
And my name is Prashant Paramaswaran. So I'm a fellow both with the Wahba Institute as well as our Asia program. And my focus is on, so I look at competition primarily from a foreign and security perspective, and I also have a regional focus on the Indo-Pacific with a focus on Southeast Asia.
Thank you very much. So, Denai, let's crack on with PGI. I think everybody's very eager to hear what it is, what it does, and if you can give us a bit of an overview of the genesis, because I think that there is a lot to it, both nationally but also internationally, and link with of a global gateway in Europe, and for example, the focus of what you have now and some of the current activity that the PGI has been undertaking.
Absolutely. So as you mentioned, the Partnership for Global Infrastructure and Investment, PGI for short, was launched at the G7 Leaders Summit in 2022, where President Biden and his counterparts came together and committed to mobilizing $600 billion by 2027 for infrastructure in low and middle income countries. The U.S. committed to mobilizing $200 billion of that, and Global Gateway committed to mobilizing 300 billion euro, with the other partners making up the difference. On the U.S. side, we focus on a number of sectoral areas, including climate and clean energy supply chains, health and health security, agriculture and food security, digital connectivity, and then connecting transport that supports and enables investments across those other sectors, and all with a gender equality lens. And the intention is really to offer a credible alternative to our partners that raises sustainability and labor standards, that promotes gender equality, and that really leads and enables and supports private sector investment in infrastructure in a way that doesn't leave our partners saddled with debt. And so it really is a unique way to approach and really work alongside the partners in meeting their infrastructure needs as the gap is growing globally. In May in 2025, we announced our approach around focusing on strategic economic corridors. We're a pretty small but mighty team at the State Department, with some of us sitting at the White House. And rather than spreading ourselves thin and trying to tackle infrastructure everywhere, we have determined that we will be most successful where we can identify a small number of countries, often next to each other, where we can focus our efforts and energies. In the case of libido, certainly starting with rail and some of the connecting transportation infrastructure, where we can then layer on investments across the other sectors and thereby utilize the limited U.S. government funding to catalyze a greater impact and economic growth and accelerated prosperity for our partner countries. Currently, the strategic, or I guess flagship and furthest along corridor is the Lobito corridor, which President Biden announced at the G7 initiative this past year, where the vision ultimately is to connect the African continent from the Atlantic to the Indian Oceans, but starting with the Lobito corridor countries of Angola, DRC, and Zambia. And I can talk a bit more about kind of where we are on the corridor, but it really is the example that we're learning from and want to copy in other parts of the world as well.
So just building on what you said, let me deep dive a little bit, because I think it's interesting to have a very practical example. And I've seen, witnessing the PGI evolving in the last year, really putting that focus on particularly, I would say, complex corridor, where you have to align interests from various countries, which is never very easy. In particular, in the case of the Lobito corridor, there is a lot of interest from Angola, but in terms of DRC and Zambia, not necessarily a similar alignment. So my question is very much, as you are coordinating also agency across the U.S. development ecosystem, what is the kind of support that you're providing to that projects in particular? Because I believe that there is different needs for those different countries. And also genuinely interested to hear what has been the response from the private sector, because looking at those countries in particular, they are kind of around the B rating, right? So it's not exactly a place where investor will jump out of joy to get in there. So interested to hear from your perspective, what has been done so far? What do you think eventually is a bit missing to kind of bring the investor in? And what has been the work that you've done to coordinate all of that agency work? And again, fully appreciating the fact that this is the beginning.
Absolutely. And as I said, we are learning a lot and will continue to learn along this journey. Our work really started what we're calling phase 1 in Angola. So the Angolan government put out a tender to upgrade the rail from the port of Lobito to the DRC border. And as part of that tender, there's also a minerals terminal in the port to operate it. And we helped pull together the private sector consortium that ended up winning the bid. And in so doing, we're able to then work with our DFC to mobilize $250 million toward that transaction, which will support the consortium. It's called the Lobito Atlantic Rail Consortium, which will support them extending refurbishment work in the DRC side of that existing rail line. We then, understanding the opportunity that comes from refurbishing this rail, worked with Exim to mobilize a $900 million package for solar power that will provide, I think, 500 megawatts of solar energy into the grid as the first phase of a multi-phase financing package. And most recently, we were able to work with USAID to announce a $5 million grant for AfriCell to launch mobile money for the first time in Angola. And this is an example of where we can use the transportation infrastructure as a way to focus the energies of multiple different tools of the U.S. government to ensure that they can take advantage of the transport infrastructure, but also to focus the political engagement that we're doing in the country, that it meets the needs of our partners and what they're asking for in terms of infrastructure investments, and where we can kind of provide that focus and push for more accelerated transactions. We're actively looking for agriculture investment opportunities, health infrastructure opportunities, and this is very much, I think, the what we're trying to then expand as we move toward phase 2 of this project. So phase 2 is part of this is the 800-kilometer greenfield rail line that will spur off of the existing rail line in Angola and connect eastern Angola to the northwestern part of Zambia. And this will be, when it's complete, the largest U.S.-led transport infrastructure investment in at least a generation in the continent, if not longer than that. It's a massive project. To your point, it involves harmonizing trade and transport across 2 countries. And just in general, building greenfield rail isn't easy, much less in a pretty rural part of Africa. But this is where we were excited to bring in other G7 partners. We announced the EU in August, coming in as a major and important partner with their Global Gateway Initiative. And then a few weeks ago, we're able to bring in and announce our African partners. So the African Development Bank is coming in as a financing partner, and also the Africa Finance Corporation, which we also announced will be our lead project developer. And they will help shepherd this project from feasibility to financial close, helping corral from a private sector led and designed approach to ensure that as the project moves from feasibility through the different stages of project development, that it is shaped and structured in a way that it can accommodate the concessionary capital that it will need to ensure this is a commercially viable project, but then also bring in the different commercial and project financing that will make sure that it is sustainable and viable long-term. Really, this is, I think, a demonstration of the way that we want to approach these strategic corridors, where with the political engagement from the State Department side and really ensuring that what we are endeavoring to do meets the needs of our partners, and that they are prioritizing also these projects to ensure that as we go along, they can help loosen bottlenecks and move the project forward within their borders. But then also bringing in the de-risking support from regional and G7 partners to demonstrate that it's possible to have commercially viable arrangements for large critical infrastructure projects.
Thank you very much, Anna, for this overview, because I think that this is particularly challenging what you are tackling. I think that having worked myself in prioritization, something that is still called, I think, the Partnership for Infrastructure Development in Africa, that the African Development Bank has been working on for like 15 years. It is a very complicated task, a very big mammoth task. And I think the way that you're approaching it with lots of humility and readiness to kind of fail, but rebounds quickly seems to be, and that, I mean, willingness to learn, I think will probably make a huge difference. So let me turn back to you, Prashant. I think that, and really, since I've been interacting with PGI, I've been very excited to hear that kind of cohesive and holistic way in trying to approach the major and systemic issue that infrastructure represent. And so seeing U.S. prioritizing international infrastructure investment is excellent news, not only for the U.S., but for the rest of the world, and that they see that this is something really important. And that's why I was so happy to provide that presentation at the invitation of Secretary Yellen this week that gives the word to all of the APEC government that this is something they need to look at. But however, the U.S. is still significantly providing less financing for international infrastructure than the like of Europe or Japan. And it greatly trails the level of support provided by China. And so Mark referenced back to that earlier, and also in the previous panel, that there was a couple of working groups that assembled together to discuss that particular issue and looked at delivering 10 recommendations, particularly focusing on boosting the role of DFC and ability to attract private investment in infrastructure in emerging economies. So as a fellow of the Wilson Center, I would be very keen to hear from you a kind of an overall summary. I'm sure everybody has done his homework and has read very in detail those reports, but always good to have a bit of a reminder. So if you could share with us the essence of that summary of a recommendation would be helpful.
Sure. Thanks a lot, Maria. So I think I'll maybe go back to what Ambassador Green said, I think, at the outset, which is a very pithy way of summarizing it, which is this is chiefly about being there. And I think sometimes being there involves the actual projects themselves. I think in other circumstances, it's creating that enabling environment that in some of these countries, I think Shihoko referenced Southeast Asia and some of the more developing countries, the enabling environment may not actually be there fully, but we still need to be present in terms of shaping that enabling environment. I think in other cases, you're sort of more in the preparation phase, which is still quite significant, but how do we do that with all the studies and the reviews that are required before we actually get to the project phase? And then I think in other cases, even when there are successes, making sure that we comprehensively and inclusively tell that story in a very convincing way. Because I think to your point about the comparison with China and some of these other countries, we have a very it's a democratic government for sure, but sometimes it can seem to other countries a little messy. We have a lot of acronyms, and sometimes some of these countries have trouble sort of wrapping their heads around this. So telling a very cohesive and integrative story is really an important part of that conversation. I actually had an opportunity to be down in Laos last year, and there's a Laos-China high-speed, not very high-speed, actually more like medium-speed railway project that is happening there. And, you know, there's a local story and a narrative. I had an opportunity to speak with a Laotian student about the dynamics of competition and what her views were. And she said very simply, you know, I've seen more of my country through this project than I have in my life because the quality of roads in Laos are quite poor. But in the same breath, she also mentioned the fact that she was aware, not necessarily from Laotian media sources, but from other sources like Radio Free Asia, for example, that some of the families who had been resettled hadn't quite agreed to the resettlement terms. And in fact, they still haven't been appropriately resettled as part of those projects. And I think sometimes it's very easy for the headlines to grab at some of these flashy projects, but we don't really sometimes see that whole very inclusive story. We see it in bits and pieces, but I thought it was really striking to me that even a regular sort of citizen was able to see and piece these various bits together. And I thought it was a really powerful example. I think one other bit of that kind of informational piece is also telling our own success stories. Some of them may be related to initiatives like PGI. Others may be actually more incidental. I mean, I recall, for example, a South Korean shipyard that was going bankrupt in the Philippines near a former US base, Subic base. And the American private sector, together with the US government, stepped in and actually prevented that from going to a Chinese company. Now, that wasn't something that maybe was very strategic and a product of long-term planning, But I can assure you that that's a story that Philippine officials still tell today. In fact, the Philippine ambassador to the United States still mentions that as a very strategic example of kind of the work that we're doing. So I think in some cases, it's a relative game in terms of what we're doing with respect to China and other countries. But as I think Nisha very effectively said, if to the extent that this is a competition, it should be a competition on our terms. And it shouldn't be just kind of a negative example countering what another country is doing, but what do we really stand for in this very contested sort of landscape?
Yeah, thank you very much for sharing that. I think that the project that you mentioned in Laos, I think is there was also a road and that actually precede that I had it used to be involved in terms of development a couple of years ago. So I think it illustrates very well the fact that, and I think the Deputy CEO of DFC said it too, it's really ensuring that by bringing that partnership, you're also bringing alongside the ability for those projects to be really transformative for their economies by being sustainable, resilient, inclusive. And I think that this is very important at the same time that message get to government, because when you're an emerging economy at a time where interest rates are really high and then fiscal space is very constrained, it's very hard for governments to hear that they need to do better infrastructure. They just want to do more. So I think somehow there is a need to double up that message to those governments. And I think that, the role of also the like of PGI and working with all of those agencies, ensuring that there is that kind of enabling environment that is constantly hammered, I should say. But then I'm interested to stay in APAC with you, Prashant, because you've also been doing a little bit of work, and we've touched base on that. I think Mark touched base on that at the beginning of in the introduction at the panel, because we've just heard from Denai about the PGI and its partnership with the EU for the Global Gateway. There is a couple of other partners, but there are other type of sandboxes, I will call them this way. And I think this is great to have. What I see is that the community now realize that we've tried the same recipe and push very hard the same doors for so long that it didn't work, that we need to try new things. And one of it is a JETP, right? And then since COP26, there has been a lot of announcement. They're all very different in essence. Some of them are are like country initiated. Some of them are more partner country initiated. And again, I think, there is no right or wrong in there. I think the idea is just to try new things. But very interested to hear your perspective on how they're doing things, how do they approach things, and how do you see that complementing with the lack of PGI? Because once again, it's important to test out a few different things, but from the private sector perspective, it's still very hard to follow. And where do you actually see the right vehicle for the private sector to be able to jump in efficiently?
That's a great question. And I think to Denai's point, I think on some of these initiatives, we're seeing these corridors form where there are opportunities for cross-border collaboration by virtue of proximity. I think in other cases, for example, in Southeast Asia, so we've seen the Libido corridor, we've seen the sort of IMEC example, for example, India and the Middle East. In some of the other regions in the Indo-Pacific, it's actually a little bit more challenging to get these countries to come together in a sort of integrated corridor. So, for example, in mainland Southeast Asia, the sort of Mekong subregion, there have been, as you mentioned, sort of, Maria, various initiatives that have been undertaken, some by development banks, some by either private institutions, or some individuals trying to set these up and trying to come up with a framework. But in the context where you have a civil war going on in Myanmar, for example, it's tough to think of the sub-region in a very cohesive way. And I think JETP is a great example of how you can marry some of these corridors with bilateral initiatives that focus more on that energy transition piece, which is a key sector, and also, to my mind, a very effective way of getting past this debate that we've been having for a long time about developed versus developing countries and the global south. And we all know the arguments on either side, but the reality is that there is financing that is required by these countries, not for 5 years, 10 years, 20 years, but now. And so putting a sort of tangible project on the table is a good way to at least start the conversation. Now, obviously, as you sort of pointed out, there are some challenges when we put that conversation on the table, because we're putting a conversation that is very comprehensive. So in Indonesia, for example, the JETP partnership, we've seen a lot of public commentary about the Indonesian officials saying, where's the money, how are we getting it, and so on and so forth. And I think going back to my point about narratives, I think that's an important consideration. I don't want to diminish it, but I also think it's really important for us to keep the eye on the prize, which is we are promoting a more comprehensive conversation. So part of it is about the financing, but part of it is also the fact that you have coal plants in Indonesia, and if you're going to have workers that are transitioning away from that industry, where are the jobs going? And as I said, in some of the other actors in the Indo-Pacific that are promoting infrastructure initiatives, that's a conversation that happens after the project is built, and sometimes it doesn't even happen at all. But we're having those conversations simultaneously, so we're going to have challenges in how we do it, but I think it's an important conversation. I mean, Vietnam is the other example of the other big JET-P project, and there we've had a conversation about financing and a very different kind of government, but we also have a parallel conversation about environmental activists, right, and their welfare and well-being in Vietnam. And I think that's created some challenges and public commentary as well. But to my mind, as both Indonesia and Vietnam is where the United States has had, signed major upgrades in their relationships. President Biden was in Vietnam earlier this year, and President Jokowi was here and just signed a comprehensive strategic partnership. So 2 CSPs with 2 very important countries in Southeast Asia. And I think the purpose of those relationships is to promote a comprehensive relationship with these countries. So we're going to have these conversations, but I think it's much more useful to have these conversations now, before the fact, rather than after the fact. And so it's good that we're having them, but in both cases, as you pointed out, there are challenges, and we'll have to overcome them.
Definitely something that we'll need to follow, and it's true that we've seen a lot of back and forth from some of those partnerships. I think that it's important. A lot of private sector are sometimes reaching out to us to say which one should we actually be involved in. I would actually all if you can, but it is hard. And at the same time, I think that there is one of those ones will definitely demonstrate, I think, a few good transactions. It's just a matter again that we keep on trying pretty hard. Let me try now to go back to one key question, which is PGI is here to really support emerging economies, and you mentioned this for the Lobital Corridor. We've heard earlier from our colleagues at Morgan Stanley that obviously capital is available. It's largely senior debt, let's be very honest. And the massive issue that we have in emerging economy is that we're really looking at greenfield projects that require a massive amount of preparation. So through a study that I did a couple of years ago in a different capacity, and the numbers haven't changed very much because my organization still monitor that, is the amount of capital available for project preparation. And this is very limited. If you look at all of the actors on the multilateral side, they're not necessarily all of the bilateral which is actually available, but in between Africa and Southeast Asia, you're roughly at 5 billion committed within project preparation facility, which if you think at an order of magnitude of 10% of capex, I mean, this is 50 billion. This is very, very, very limited. So I think still the elephant is in the room, because we could discuss about creating the right enabling environment on the legal side, on the regulatory side, but then ultimately you need tangible money coming from public sector or DFI to develop that stage. The private sector will never come into such kind of very early stage. Some very elaborated, there are a couple of examples that show that when you have some cost recovery for certain type of projects, some money from the private sector could come in there. But except if a private sector as a firm that is involved is also a co-developer, which is not that many of those profiles that you have out there, the reality is that money will have to come from the public sector. So interested to hear particularly the view of what PGI does in the space or intending to do in that space, or eventually also a potential role that it will have to coordinate that, because one big thing that we haven't discussed here is also in parallel, the efforts that is led by the MDBs, very slowly, I must say, on creating country platforms and ensuring that there is, at a country level, a coordination of actors between the various DFI and MDBs to ensure that there is a real cohesive proposal going to the government, so that also governments themselves don't have to deal with too many players in an uncoordinated way, and also hopefully being able to kind of fast track some of those projects, because I think that's another also element that I'm interested to hear maybe your thoughts. It's going to be a lot of questions in one, I'm sorry. But basically saying that, well, look, part of the issue that we also see in emerging economies is that it takes too long. Right, and DFC, for example, is a very good partner to provide PRI. I've done the experience, but then MDBs are not as fast. But how could we actually fast track this even further? And I know that the private sector is quite keen on seeing that kind of fast tracking, because if you say to an investor, please monitor that project for 7 years, well, that happens. Some of them do it, very few of them do it. Some institutional investors have been seen doing that in APEC, for example, on pension funds from Canada, following 7 years of projects, but very largely, very few will do that. So interested to also hear, particularly the project preparation is one angle. The second one is really how do you think you could help fast tracking some of that process?
Yeah, it's a good question, and I think the panel after this will talk a little bit more about how to empower DFC, because that's a key piece of some of the response. On our side, our primary tool for project preparation is US TDA, the Trade and Development Agency, and they're very close partners with PGI. And I think they could certainly use more funding and a lot more support. And we're advocating wherever we can for more funding for them and for some of these global project preparation facilities as well, because that is a really key piece of it. On the PGI, kind of where we currently have and the resources that we have today, it has been helpful for us to provide the focus priority corridors, because that says, if TDA has $2 million, they can put a certain amount of it in one place and really do multiple types of projects, and that ensures that that money goes a little bit further, because there are leveraging effects. That said, more resources I think would be helpful across the board more broadly. From a speed perspective, similarly, I think the prioritization of the corridors has enabled us to work with DFC and say, in order for this rail project, it needs to be accelerated, because then that is going to enable us to put in the digital connectivity alongside the rail, lay the fiber, for example, or the faster we can get the rail built, then the sooner the agribusiness can get its inputs and exports out to market. And so how do we use the focusing effect where we have ready and willing countries that have similarly and aligned priorities in terms of their infrastructure, and we can bring in other partners to help fund, to use the resources that we have more effectively. It doesn't solve the total amount issue, which is real, but the prioritization that we do with DFC and other partners has helped them at least move faster on some of these very strategic projects that are interlinked.
And we heard from the last conversation, and I'm just going to bounce back on that one, because that was really also a key discussion we had at the APEC on modern supply-side economic, which is research and development. And ultimately, with PGI focusing on particularly investing in emerging economies, we want to help them to kind of leapfrog the status of infrastructure construction as we're doing now, which is building the way we were building 150 years ago. And so interested to hear from you if there is a specific focus through those particular projects, or a more generally intended for PGI to support that kind of R&D and ultimately more technology within projects, because I think there is a fantastic opportunity, as I said, to realize more economic, social, and environmental benefit. And also helping those countries to show and pioneering some of those technology that in return could support their country and their economy to showcase their ability to have those technology in-house and create even more benefit to the economy. Interested to hear your views on that.
Yeah, absolutely. I've spent most of my career on the continent of Africa and love, in fact, more than 5 years in Kenya, where they launched mobile money well before we did in the US, and love the concept of emerging markets really leapfrogging some of the more institutional structures that we have. I think with every project, and PGI is very transaction focused. I would like to say we have a master plan and we've mapped out the resources for 5 years, country by country, but we really haven't. We are, as I said, learning as we go along, and kind of where we identify strategic projects, we run with them and try to move them forward as quickly as possible. And with each of these projects is an opportunity to bring in vendors, whether they are U.S. vendors and market opportunities for American companies, but also our G7 partners to showcase for our either private sector partners or government partners what is possible. And then ultimately, these need to be led by our partners. So it's not necessarily, this is what we think you should use, but here are some options for you. You can select and we can support how to make your visions and dreams for your countries possible.
Now, I think that's a key role, I think, that the PGI could actually play. And obviously then going back to that like commitment that has been done by the US and the expectation for the private investment to come in, could you tell us more about what is your current interaction with the private sector? How do you get the feedback? And as we have some private sector participants here, what would you like to hear more from the private sector as you continue shaping and learning on your learning journey with PGI? I think that would be very interesting to hear.
Yeah, that's a great question. And actually, just before this, I was with the President's Advisory Council on doing business in Africa. And so they asked me the same question, how do we better engage with the private sector? And I think on the first hand, there are a lot of companies that don't even fully understand the suite of U.S. government tools. And I actually don't know how to solve that, but I do think finding ways to get the word out would be really critical, because we do have a number of U.S. government tools that are meant to de-risk and encourage and incentivize U.S. companies to take more risk and alongside us, whether it's directly in a project where we're co-investing or looking at the investments that we're making that hopefully de-risk some of the operating environment where you can then invest directly in these emerging markets. And so, you know, if you hear nothing from me today, I encourage you to come and invest in the Libido corridor and in the other PGI corridors. And if you have specific projects that you think would fall under our focus areas, reach out to me or anyone on the PGI team, because we do want to, we're a small team, we can't necessarily scour and identify all the projects in advance, and we love to see inbound requests. Work with our embassies in country around the world, but also you can come to us in DC, and we really do want to hear the great ideas that you have and how we can support them to make these corridors successful.
Oh, that's great. And working for G20 economies, it's not that often that you have an open, invitation to provide your feedback. So do it, because I think that's important to highlight, because a lot of governments are, usually not that much interacting with the private sector, but still keen to see things happening. So really kudos to you on that.
Can I actually add one more thing? We have had a couple of private sector forums. So on the sidelines of the UN General Assembly, and actually this week in APEC, we're doing investor forums. They are kind of high level for large financial institutions and institutional investors. And that is important when we think about moving large amounts of capital in a more coordinated way, and on the more project-specific interactions, reach out to me. And we kind of are taking both approaches.
So, Prashant, I'm interested to hear from you as we're reaching the end of the panel. You mentioned a bit about overall the work that you've done on the recommendation, but any kind of specific, view or advice as to PGI also as they are continuing their journey on what you think is a core focus? Because I think the issue that we're all facing in infrastructure is that the list of priority is massive. Is how do you actually sequence that? Where the reality, it's probably within the nonlinear spectrum of mathematics, right? There is no one single answer to that equation. But so having your thoughts about as that learning journey is going on, about from the recommendation, and also maybe highlighting a little bit more, if you can share, how you think that the work of that working group will continue, because I think it's definitely adding a lot of value to the discussion.
No, I think there's a couple of things. I think one, if I were to just come up with one word to sort of summarize it, it would be, partnership, right? And I think that is essentially the key word. One of the asymmetric advantages that, as we talk about strategic competition, one of the advantages that the United States has is this huge network of allies and partners, some of whom have done a lot of work already on infrastructure in different ways, in different characterizations, different methods. But I think some of them are further along, and they have a way of contributing to that conversation as well, whether it's by themselves or with us on different aspects of this. I think in particular within the Indo-Pacific, which is, we should always keep in mind, 2/3 of economic output this year is coming from the Indo-Pacific region. That's where a lot of the economic activity is. And within that, Southeast Asia is the world's 5th largest economy. And a lot of other partners are doing a lot more in this region. The Australians have come up with an sort of investment strategy out to 2040. They've made this public. The Japanese have long done connectivity. In fact, when I had a conversation with an ambassador in the region and we were talking about US-China competition, he said, on infrastructure, it's less a US-China competition. It's actually a China-Japan conversation in some of these cases, like Indonesia, for example, where the Japanese lost out on a high-speed rail project that the Chinese just finished out on. And I think it's really important because the Japanese, they had the, quality infrastructure that they've been promoting, but they've been developing it. They now have a vision called comprehensive connectivity, where they're thinking about connectivity and infrastructure not just on the digital domain or physical infrastructure, but also human infrastructure and connectivity. I mean, how do we sort of think about this from the perspective of human capital, which I think is really important. And so you have a number of countries that are already doing things. And the big question, I guess, it's an asymmetric advantage for the United States having this broad network of allies and partners. But it's also a challenge in that we have to figure out what the right division of labor is, right? What does the United States do? What do other countries do? What do we do with them? And maybe what do they do separately? So that's one piece of it. And I think the other one, I go back to my background partly in sort of media and strategic communications. I can't sort of help myself, which is I think the narrative is really important. Making sure we have a positive vision for what we're doing. And even as we go through the inevitable sort of rebranding of certain initiatives, who's working with who, telling a very concrete and sort of short, concise story about what is it that we're standing for these countries is going to be very important, because I think, as Danai just mentioned, sometimes some of these countries a little bit confused and they may not have an understanding about what's happening, but as you pointed out, in some cases in our system, some people don't understand some of these aspects. And so I think sometimes we're doing a lot of stuff already. It's just showcasing the story that we have in a very comprehensive way. Some of that we can do ourselves, but others we may require the assistance of some folks in the media, think tanks, and other communities to help make sure we have a coordinated message.
Thank you very much for that. I think that's definitely also giving a bit of sort of guidance about what will come next, and looking forward to see the work that you're going to do on that regard. Maybe one very last question, because it was touched base upon in the last panel, and interested to hear your perspective from a PGI perspective. It seems we're asking you a lot for PGI to cover. Sorry for that, a bit of pressure. But I think that one key aspect that we have seen through our research at the GI Hub, that I've reported to G20 finance minister and central bank governor, is the complete alarmist situation of infrastructure debt provided by banks, particularly declining because of Basel III and soon Basel IV. And this is a particularly worrying element, because if that source of debt is not available, there is a risk that countries will actually search for that type of debt in a less sustainable and transparent way. So this has been a lot of discussion at the G20 for many years, actually, and through what we call the debt suspension initiative. It was pushed at the time by the couple of G7 countries. But I think that we are really at the crossroads, because we had a risk of creating a real unbalanced division, global north-south division. I think that's very much what we are seeing. And so while some of those particular regulations discussion needs to happen at the like of the G20, and I wanted to share some good news with our bank colleagues that we have been doing a lot of work with the Financial Stability Board to ensure that we could create a report that will show the risk and the benefit, because those two things have to be evaluated very carefully. Nobody wants to harm the global financial safety net, but at the same time, there is a real opportunity now to look back again at adjusting those capital requirements, just because of those declining trends. And I think there is a lot of support that we're now receiving from central banks, particularly the greening network. There is a green part of the central banks. But then we are back to what is the definition, and under which definition you're actually providing those adjusted capital requirements. But so these are kind of global discussions that are happening very slowly, too slowly, if you ask me. But at the same time, interested to see if PGI is providing, beyond the work that you're doing on specific projects, some kind of work at the regulatory level into some of those countries, some sort of the type of work that the IMF could do on budget support, for example, at the more bilateral level?
It's a good question. I think certainly we are championing the U.S. government's conversations on MDB reform and infrastructure investment writ large. And the Treasury Department and the work that they do with the different MDBs. I would say our office at the State Department is primarily focused on implementing PGI and is very transaction specific, but where we can work with partners who do bilateral budget support to these countries in support of the projects that we're focused on, that is where I think we can get very narrowly focused in a way that will help. So, the African Development Bank being a partner for the Libido corridor, some of their contribution, and they just announced $500 million toward the project last week at the Africa Investment Forum. Some of that will come, I think, in
Budget support.
Exactly, in budget support, and potentially other partners coming in later on.
Well, thank you very much, Denai. I think we've reached the end of our panel, and I'm very grateful for all of the insights that you've provided. I hope that our audience has a better understanding about what the PGI does, and definitely very keen to follow the development, in particular on the Lobito corridor, but many other projects. You said you're a small, nimble team, but I've seen you firsthand, very active and very eager and very keen on all sorts of partnership. And I'm sure many people in the room will reach out to you and provide even more insights or feedback. So on that note, thank you very much, and looking forward to the rest of the discussion this afternoon.
Well, thank you, panel. Again, one more round of applause for our panel as they exit here. Very, very complicated issues we're facing here. As you've heard, we've raised some questions that we haven't even yet fully addressed yet, like how banking regulations through Basel III, IV might make the world safer as it relates to the capital of banks, but also make less debt available to these developing markets and cut against our effort here to mobilize more private investment in infrastructure internationally. So a key variable for that, as we heard earlier when we kicked off this activities with Nisha Biswal, the Deputy CEO of the Development Finance Corporation, talking about the role that they have played and how far they have come since they were birthed about 4 years ago, and are building up the infrastructure of the organization to be able to really help lean into activating more private investment. And so we're thrilled that we have a panel here led by the Wilson Center's own Eddie Acevedo, of lawyers that are very experienced in development finance. And they have worked very hard to come and dissect what are the ways that we can bring more capabilities, bring more talent, bring more authorizations to help the DFC play the vital and instrumental role that it plays. So I turn it over to Eddie Acevedo, Chief of Staff and Advisor to the President of the Wilson Center.
Thank you. Thank you so much, Mark. Appreciate being here today. Thank you so much to our wonderful panelists. As Ambassador Green mentioned off the top, the Wahba Institute, as a refresher, as we call it, WISC, launched these 3 working groups on business, legal, and finance. The goal was to pool their expertise and insight into how to unlock and increase private sector investment into international infrastructure. Obviously, we would not be here today without our dear friend, Dr. Sadek Wahba, the chair of WISC and a member of the Wilson Center National Cabinet. I'm honored today to be with my fellow panelists, and our panel is entitled Empowering Development Finance Corporation for Greater Impact. And as we move into the reauthorization stage of the DFC, it's a perfect time to have this conversation. So I thank my panelists. I will add, in order to save us some time, I'm going to skip a little bit the bios. You can go on our website and learn more about our distinguished panelists, but I feel like we want to just jump right into it. Kimberly, let's start with you.
Sure.
So I happened to be at USAID when we created the DFC. And one of the things, the main conversations we were having at the time was this linkages between USAID and DFC. And a lot of the conversation stemmed a little bit from at USAID, we had the Development Credit Authority. Mm-hmm. We were going to roll it into DFC. And, you know, the USAID missions around the world were supposed to be what we called the deal spotters, and to help the DFC sort of foster some development finance. And I think as the years have gone on, this continues to be a bit of a question over the DFC and specifically the D of the DFC, the development portion. You know, do you believe that sort of both objectives in terms of development and incentivizing private sector investments, can they realistically coexist within the DFC, or are sometimes both of those objectives going into sort of different directions?
The quick answer to your question is yes, absolutely they can coexist, and not only can they coexist, they will thrive together. But just to take a little bit of a step backwards, as we've sort of heard already today, the infrastructure financing gap that the world is experiencing right now is about $15 trillion by 2040. And in the developing world, it's $6 or $7 trillion. So clearly, that money is not going to come all from government balance sheets. That is absolutely clear to everyone. So the question is, where else will that money come from? And really the only other source that money can come from is the private sector. So the development finance model is really based on a continuum of funds. You start with ODA, Official Development Assistance, which is USAID, MCC, TDA, all fantastic organizations. Basically grants. They're not just grants, but for ease, let's just call them grants. Those grants are provided significantly to the lowest income countries and significantly to social infrastructure, if we're talking about just infrastructure. Then you've got on the other end of the spectrum, private capital that just goes in and invests and doesn't need any risk mitigation from governments, et cetera, et cetera. But then the question is, how do you get from the grant situation to the private capital situation? And that's where development finance institutions like DFC step in. And their role is to catalyze this private sector money. So why does the private sector money not want to go in to some of these markets? They're risks that they're not willing to tolerate or able to mitigate. And really at the end of the day, when you really dive into the risks, they're political risks of one type or another. And so the US government or multilateral development banks or other bilateral development finance institutions come in and help to create structures and products and other things to mitigate some of those, at the end of the day, political risks. Even if they look commercial, they're political at the end of the day. And so, as I said, USAID and that grant ODA money generally goes in with the lowest income countries and for social infrastructure. So 90% of ODA goes to low-income countries. And almost all of it, as I said, goes to social infrastructure. When you get to middle-income countries, that's where the DFC really shines. And then the numbers break down about 50-50 between ODA and development finance. And the ODA money that comes in tends to be more for that social finance. So this model was really implemented for the first time when the World Bank's International Finance Corporation was developed opened in 1956. And since then, as you guys all know, there are tons of DFIs, multilateral and bilateral DFIs. And just to give you a few examples of how this model works, how well it works, again, not just DFC, but having the entire continuum. 20 years ago, DFC was eligible to provide financing to 120 different countries. Today, that number is only 80. So that's a 50% decrease because income levels have gone up in all of those countries. 20 years ago, there were only 57 high-income countries. Now there are 83. That's a 45% increase. And ODA plays a major role in that, but so does development finance. And some people will say, well, if you've got private sector money, foreign direct investment, is that really developmental? Or aren't they in there just to make a profit? And that's fundamentally inconsistent with development. And the answer is no. It is consistent with development because remember, we're talking about economic development here. It's not social infrastructure that we're talking about. We're talking about development of more hard assets, infrastructure, power plants, roads, ports, et cetera. And when FDI comes in, when the private sector comes in, the development components that are there include things like transfer of technology, including new capital products that have never been used before, promotion of competition in the domestic market, very importantly, capacity building. People, local people, host country people are trained on how to do things, both from a technical perspective and an economic business perspective. And the government gets revenue through taxation of the entity that is doing business. So DFI investment also, when you think about these huge numbers of 15 trillion, 6 to 7 trillion, there's a big difference in how the money is used. So $7 billion of USAID money going out for assistance costs the taxpayer $7 billion. $7 billion of DFC financing costs the US taxpayer $0. Because the reality is that the DFC and previously OPIC has always made a profit, not a huge profit, because that's not the goal, but they have always been able to return money to the US Treasury. So it is this combined power of ODA, grants from USAID, development finance from the DFC, catalyzing private sector finance that substantially improves the lives of so many people around the world. Now, that doesn't mean that it can't be improved. It absolutely can be improved. I spent 3.5 years at OPIC as general counsel, and I promise you there are ways that it can be improved. And that's really what we are focusing on here today, being really practical about how DFC can be more effective, can be more efficient, can work with the private sector better.
Thank you so much. Could not agree with you more. I think part of the role of not only the Wilson Center, but what we're trying to do at WISC is to provide that platform for the business community, right? A lot of times policymakers, and especially my former colleagues on the Hill, like to think they know better when it comes to the private sector, when in reality, receiving and getting a little bit more input on how to make things better will really go a long way. But you talked about sort of how do we make it more effective, and Tara, let me go to you. Now, one of the tools the DFC has in their toolbox is to be able to activate more private investment through investing with on equity. This is something that I think I'm sure in the private sector community is not revolutionary. It's not anything new, but I think for many of those in Washington, the equity issue continues to be a hot topic around town and how this operates within the DFC structure. Can you provide us a little bit more context on sort of why is it essential for activating private capital And how can the government limit its risk in providing equity financing?
I think the most important thing is, right, it's how you basically seed a company and how you start it out is oftentimes the most successful thing for its success. So, and we've seen this in other programs. The DOE program is an example of where the private sector came to see government involvement, especially in emerging markets where it's risky, as almost like a good housekeeping seal of approval. There's an element of rigor to the underwriting. There's diligence. There's relationships with host country governments and related entities that you might deal with within the countries. There's paying attention to permitting and siting and regulation and environmental concerns, right? So the sooner an entity like DFC gets in, probably the better off the company is in terms of flourishing. The other thing that's available to early stage investors, in addition to, for example, better returns, more attractive investments, and smaller slugs in more places, is there's just better governance, which we see even in the United States is key to the success of a business and also the return of capital to the investors. So, and it becomes very important because with all the sanctions, money laundering, there's just more available to the government, so they will lead other equity investors through the fire, if you will. So, and the other thing too is we're seeing, back in my day, if I was doing a big deal for OPIC, it was often and Laura, you remember the days, right? A big old power plant, right? 1,200 megawatts in the middle of Africa, or a toll road in the middle of some Southeast Asia. It's really not those deals that are going to make a difference in the world as much as it might be a tech startup. It might be, the energy transition is so reliant on the tech. So it lets, it accommodates smaller investments, it accommodates support of young companies, and often the entrepreneurial spirit within a lot of these countries. I do think one constraint that they've had is the scoring mechanisms that limit the ability of the agencies to do it. So Kimberly is more informed on those equity scoring metrics than I am, but there's a lot of arguments for putting in early stage equity to any company.
Yeah, and so the real recommendation that we have in our paper is about the equity scoring. And apologies to all of you. I will try very hard not to be terribly wonky in this. And apologies if you actually understand everything that I'm going to say, because that means you've gone into the world of credit subsidy and it's damaged you in a real way, because it does everyone. But the way that there's an act called the Federal Credit Reform Act, and that is how OMB scores loans and loan guarantees. It doesn't contemplate how to score equity. So OMB doesn't know what to do with equity investments, how to count it in the government's accounting and the government's financials. And so what OMB has done up to this point is really just count it as a grant.
Right.
Like, you're never going to get it back. You're just giving the money away. There's no contractual commitment for you to ever get the money back. So it's a gift, it's a grant, there you go. Now, I know the folks at DFC. I have a lot of respect for the folks at DFC. But even if DFC were like the worst equity investor ever, the likelihood is that they'll get back at least a part of their equity investment. And the reality is, looking at other DFIs, they make a huge amount of money on their equity investments. So our proposal is, and it's something that the Senate Foreign Relations Committee has actually already put in a draft bill, Senate 3005, I think, and that is to not amend FCRA, the Federal Credit Reform Act, because that's sort of a third rail in a lot of ways, but to say we will figure out how much subsidy needs to be allocated for an equity investment based on the net present value of the equity investment. Relatively simple for those who understand that. The issue comes in when you have to figure out what the discount rate is, because under FCRA and OMB's way of thinking, the discount rate is based on a repayment schedule and an end date for the loan, when all of the loan has to be repaid. Of course, with equity, You don't have that. Now, if you're investing in investment funds, an investment fund will have an end date. And so you can use that as your end date for your discount rate, which is what we are suggesting. We're also suggesting that you have a reasonable projection of when you will dispose of your equity, when you will sell it, when there will be an IPO, et cetera, and you use that. Now, these things get re-estimated every year. So it's not like what you say in year one is going to last for the entire investment period. If it changes each year, then you redo it. So that's what we're suggesting. And we're also suggesting that there's a revolving fund so that DFC is able to, again, more clearly recycle this money so that profits from their equity investments come back in and they're able to use that money as credit subsidy for the future. Again, wonky, but it's really about discount rate, and it's really important, and we really want Congress to push OMB to do this.
I mean, this may be beating the dead horse, but it is the reason the scoring is so important is that's the wonky piece of it, is that DFC is utterly disincentivized from using a dollar of subsidy for equity.
Right.
They're going to use it for debt. And so Congress has given DFC a tool that, in fact, it is unable to use efficiently because of the scoring. So,
Exactly.
And I think, Laura, you hit on a point that we'll hit later with some of the debt products, subordinated debt, is the other agencies in other countries, multilaterals, they don't like the fact that DFC is rolling up with debt, and they're putting in equity, and they're structurally subordinated, right? So it's some people
So
in this
work and
room
play
I know
well
have
together.
fought that fight for years. I'm looking at some of you now. So it's been tough, right? Nobody likes to be, nobody wants to be behind a government, a U.S. government agency like DFC. So it does lead to a little bit of high temperatures in the room, if you will.
Yes.
Let me go to Laura on another topic that sometimes leads to high temperatures in a room. We know that a lot of times when we're building these deals, the review process at times can be slow. It takes time to identify the deals, create the deals, and sort of get it through the whole process from start to finish. What do you think are some potential ways that DFC can speed up the cycle so that the review process could be expedited?
So I think we should start with recognizing that the deals that we're talking about, we want to close this infrastructure gap. These are not easy deals. They're hard deals, and they will take time. So we start with a baseline of, you're working with with complicated transactions. And at the same time, the other factor is that you're working with an agency and a group that has scarce staff resources. And so how do you balance these two things? And I guess I might add a third thing, which is with the authorization or the creation of DFC, the expectations for the agency in terms of the number and type of deals that are supposed to move through that assembly line has gone up tremendously. So you've got hard deals that take a while, scarce staff resources, and a high volume, or that's the aspiration at any rate. So now what do you do to address some of that cycle time? You don't necessarily want to, cut back on the structuring. That's what keeps it safe. What you can look at, however, is how does the review at the end, and in particular the board review, how does that work? And right now, one of the changes between OPIC and DFC was to increase the size of the board quite a bit, and yet not necessarily increase the resources, the staff resources. The headcount's gone up, but not proportionally to what the agency is supposed to be doing. So our proposal would be to a couple of things: fewer members on the board. The policy members be moved to be ex officio, non-voting members, and then an emphasis on investment and finance expertise, so that you really are getting the benefit of the kind of review that you need at that stage. And I would add another, which sort of flows from this, is that if you do have a permanent board, with expertise, you can have more board meetings, right? And so you can move faster through that assembly line, assembly chain. And, you know, our view was that this would reduce cycle time by reducing a couple things. I mean, you have more throughput, but you also reduce the amount of time that staff, whatever that project team is, has to spend on a particular project at that review stage. So with a policy-heavy board, that staff is going to be spending a lot of time explaining the details of of how the transaction works, as opposed to the policy implications of the transaction. And you know, that's time that team, if you will, finite resources, could be spending on a new project. So that's the impetus behind that. Will it solve everything? No, but it should help with some of that cycle time.
Thank you. Tara, let's go back to what you had mentioned earlier about the subordinated debt. Help our audience a little bit understand what that is, why is it important, and what steps are needed to make it easier for the DFC to offer.
Well, effectively, it sits in the capital stack behind the senior debt. And the issue for a lot of projects in these emerging markets and in these some of these sectors is that there's only so much equity you're going to raise in the private sector at all. And even the agencies do not have a lot of equity money that they seem inclined to put on the ground. So if you bring in sub-debt, at least you're collateralized in some regard. You sit behind the senior debt. You benefit from the diligence and the collateral that the senior debt has, like if there's anything left over, you know, in a workout there often isn't. But there is a collateral package available to you on a subordinated basis. There's a lot of diligence. There's banks ahead of you with governance. Oftentimes you're very subordinated to those lenders. But in most jurisdictions, it will give you some type of seat at the table in the event of a restructuring or a workout. So there are protections available to you that you wouldn't have straight as equity. Your return is higher, and it also fills what we find is gaps in the capital stack. Say you have an equipment delay or a problem of that nature. We saw it a lot with the supply chain. Well, oftentimes sub-debt comes in and they can fill a hole that the senior debt doesn't, you know, they're either at capacity, they don't have the approval for it, and you'll find more flexible capital providers. So if the agencies took sub-debt, they can move those projects along that might be stuck, they may be stranded, they can really solve some problems, and I think that having different tranches of debt would be beneficial to everybody in terms of getting something to commercial operation of some type, whatever the business model is. But I do think historically there's been an institutional bias against sub-debt, which, you know, is not necessarily unwanted. You know, Citibank may not want to do sub-debt on a big project or things like that. But also, I think, Laura, you're more familiar with the BUILD Act than I am, but you need a substantive policy reason to do sub-debt. So I think people are getting, you know, trying to figure out what's the substantive policy reason and how they might justify it. So I think if they became more facile with their justifications, things might be more.
Yeah, I mean, one substantive policy reason might be to close the infrastructure gap, and you know, to push through on that point. The build-out's interesting because, I mean, it's interesting for a lot of reasons, but one of the interesting details is that there's a lot of granular detail in the Act that was not present in the Foreign Assistance Act. Mm-hmm. And in terms of, you know, commentary on subordinated debt, things of that nature, it makes it hard with a new agency as they try to figure out how do they apply these things for which there's no institutional history. And one of our suggestions would be the board could approve a policy that says, you know, we got to close the infrastructure gap, and sub-debt is instrumental in that.
Mm-hmm. And one of the advantages also to senior debt consenting to sub-debt or equity, having them go ahead instead of coming in as equity, is going back to this idea of DFC can be the good housekeeping seal of approval on deals, is, you know, adversaries are more cautious if a multilateral, a development agency is involved, right? Because behind them stands some reputable government in most instances, or maybe disreputable government. But at any rate, they're dealing with a 900-pound gorilla somewhere when they start pulling somebody's chain, right? So so having them anywhere in the capital stack benefits everyone in the capital stack. So I think that's a very important thing, both as a policy justification and to folks that might otherwise not like sub-debt. They might say, no, you can't come in as sub-debt. You need to come in as equity. I don't want you to have a seat at the table in our structuring. Think twice about that if you're a borrower or other equity, because chances are you're better off with them, no matter what hat they're wearing, than without them.
So I have to say kudos to the panelists. We've gone this far so far, and we haven't mentioned China. So good job. But now that's where we're going. So Kimberly, let's go to you. This week, as we've all seen in the press from California, President Biden and Xi Jinping had their bilateral meeting. I remember when the DFC was up for conversation on the Hill, this was a big talking point on this is what we need to compete with China. This is what we need in the era of strategic competition. Now looking on it, sort of a few years from the BUILD Act being passed, do you believe that it's true, and should the discussion include competition with China? I mean, we know that dollar for dollar, government to government, it's not even a contest. So how do you view sort of the DFC role in that strategic competition?
Yeah, it's a really good question, and it's something that I do think that we all need to think about in a really thoughtful way. There's certainly some areas where, from a strategic perspective, it is concerning that China dominates the market, and it creates significant risk. For example, with respect to midstream processing of critical minerals, over 95% of all critical minerals are processed in China. Whether it's China or any other country, having a single state where all of that processing takes place for those critical minerals is a risk, and it's a risk that needs to be addressed. And the U.S. trying to do things, take actions to encourage that kind of processing to move offshore from China, I think is a very good idea. And I think DFC is well positioned to play a part in that activity. There's also a real concern that China's model for funding infrastructure in developing markets is really not one that focuses on economic development as the US, the European, frankly, the Latin American, the African models all are, this development finance model. So I mentioned at the top of the panel some of the things that private sector investment bring in. And these are things that China does not bring to the table. So for example, there's very rarely any technology transfer. There's very rarely any capacity building in terms of human capital, et cetera. In addition, most of the money that is going into a country from China to fund infrastructure is being borrowed on the balance sheet of the sovereign, the host country sovereign, and ends up being round-tripped back to a company in China for construction contracts, et cetera. So it's a very different model. It is a model that is sometimes hard for host governments to pass up because the promises are faster, cheaper, and don't worry about it, you don't have to pay anything now because it's just debt. But at the end of the day, it does not have that same foreign policy goal that development finance has, because the development finance model is all about economic development, because where there is economic development, there is more stability. Where there is more stability, our foreign policy is served. So that's how I think DFC is in a really good place to counter some of the China investment around the world. But there is one thing that I just want to recommend to everybody to look at. It's an article that actually somebody who's here sent to me, which is from Aid Data, which is at the College of William and Mary, and is well regarded in terms of their ability to put together data on these topics. So just for some perspective, and I know that we received data on DFC for 2023, and they are growing as is intended and is remarkable. But looking at 2022 numbers for comparison, DFC committed a little over $7 billion and had a portfolio of $35 billion. Obviously, we heard earlier that number is now $42 billion. In 2022, the 15 EDVs, the European DFIs, and there are 15 of them, invested a total of 8.7 billion euros. So DFC and the EDVs are about on par with what they're doing, the 15 EDVs and DFC. Their total portfolio was $51 billion, which makes sense because until 4 or 5 years ago, OPIC's cap was $29 billion, so they can only go up so fast in a reasonable way. Now, without question, China remains the world's largest official source of international development finance for low and middle income countries. But the numbers, according to this institute at William and Mary, are that China put forward, invested $80 billion a year, whereas the USG between DFC and official development assistance like USAID, et cetera, was $60 billion. It's not nearly the significant difference that I think we all think exists. And the G7 outspent China by $84 billion in 2021. So if these numbers are accurate, and as I said, this institute has a reputation for accurate numbers, maybe things aren't quite as dire as we thought. And I put that out there as something that I know I'm going to do more research into.
The other thing I think that's lost sometimes on maybe policymakers or just like kind of the average kind of Joe is that we talk about these emerging market developmental fixes and don't always pull through the knitting. That's a Main Street problem. So these problems hit Main Street 3 years ago, and the solar industry is an example of an industry that got incredibly disrupted because of reliance on China, forced labor, other kind of non-friendly parties, if you will, issues with minerals. But that meant your solar farm was not completed in Illinois. And, jobs were lost, in Chicago or in Minnesota or Arizona, places that you wouldn't think you'd have a solar farm. So these are very important issues to solve in a very nascent way at the developmental stage in developmental regions, and China is one of the biggest challenges we have in the energy transition and in the tech markets, for sure.
And I would argue the development component is the pitch, right? So that goes back to the very first question, combining USAID or elements of USAID plus DFC, as Kimberly points out, that it isn't quite the development finance when it comes from China. It comes with some other parts that may not be so attractive. But that development, that technical assistance, that's important, and that's sort of the pitch when you go overseas.
Yeah, I think one of the things that we noticed at USAID was we cannot emphasize enough the importance of the streamlining, because even when we were dealing with governments at that time, they would sometimes rather work with USAID, even though it was a lower number, right? But they knew the money was coming through the door tomorrow, next week, the next month, as opposed to DFC that maybe was a year, 2 years out, right? And for a lot of these governments, they just don't have that luxury to sort of that waiting game to see if these deals go through. So being able to speed things up, I think, is a very important point. It's interesting because as we always talk about the era of strategic competition, we assume from the tagline that we're actually competing. And what we've realized is that a lot of times we're not even competing because we're not even there. And a lot of the folks that we talk to, when we hear that China got this deal, China got that deal, we automatically go to that country or those leaders and say, how could you do this? And they say, we put it up for bid and no U.S. company bid. And there needs to be a little bit of a soul searching here and looking at ourselves in the mirror. And again, how do we work with the private sector to de-risk a little bit for them so that they can get into the competition?
Yeah.
It's one thing if we're competing and losing and we can look at why we're losing. It's another thing when we're not even in the game.
Yeah, I think that that's an excellent point, and I will say that one of the things that DFC was able to do, which was highly controversial, is under OPIC, there always had to be a pretty significant U.S. money component. So to a certain degree, it was serving two purposes. One was it was developing U.S. business, and it was doing development impact. That is no longer as much of a requirement under DFC, which frankly is a very good thing if your focus is development impact and having more strategic competition in around the globe. So again, highly controversial as it was being discussed, but from my perspective, it is one of the best things, other than perhaps equity, that was done. And in terms of sort of streamlining things, if you guys do look at our paper, you'll see that we got very granular about some very specific things that DFC can do to help speed up the process to a certain degree. So for example, on small deals, DFC does a lot of big deals, but they do a lot of small deals, so like sub $20 million deals. DFC generally does not foreclose on anything, generally does not call an event of default and try to recover. Generally, DFC's purpose is to get the development impact. And the only way the development impact happens is if the project succeeds. And so the goal is always to get the project to succeed. However, so there's very rarely going to be an enforcement action. However, if you have a $20 million loan in Burkina Faso and they default on it, I assure you the cost of enforcing on that security will be so substantially higher than any value you get from enforcing on that collateral that it's just not worth it. And getting the security on that collateral, those assets, is extremely difficult, extremely time consuming. You gotta get legal opinions, you gotta get certificates, you've gotta register, you've gotta do all of these things. So the recommendation is $20 million loan, absolutely be willing to go in and get a share pledge, which generally is pretty easy, so you don't end up with somebody defaulting on their loan and running off with a valuable company. But that's it. So that would speed through these small deals much, much, much faster. So that's one thing. Providing 100% guarantees, that was talked about earlier. OPIC could do 100% guarantees of debt. There's now some dispute about whether or not DFC can do it. DFC strongly believes that they can. There's another government agency that thinks that they cannot. That needs to be resolved, and it needs to be resolved in favor of DFC. I'm a lawyer. I've done this a while. I've read the laws. It's clear to me. So everybody ought to agree with me. And then one other piece is, or two other quick pieces, is selling of the debt. That was also mentioned earlier. For the U.S. government, selling of debt for a variety of reasons costs credit subsidy. So it is highly developmental. It creates headroom. It allows this recycling of money better. So there needs to be an acknowledgement that this is worth the credit subsidy. And finally, increasing the board threshold for approval. When I was at OPIC, our max was $29 billion. We did $4 billion a year. We had to take deals of $50 million to the board. Now, the cap is $60 billion. They regularly do loan, and our top loan was $400 million and really $250. Now they're doing loans much, much, much larger than that. They're doing $7, $8, $9, $10 billion a year. The threshold to go to the board is still $50 million. That needs to be adjusted. It needs to be adjusted based on that risk. And we are suggesting $150 million.
Thank you. I know that we're running out of time. I want to try to squeeze in just 2 more questions. We're going to do this rapid fire. Laura, first to you. Another sort of obstacle, maybe annoyance from the private sector is sort of multiple environmental reviews for different entities of the U.S. government. In the paper, there's recommendations in terms of how do you deal with these environmental reports. How do you think this could help make DFC a more attractive partner for the private sector?
Well, we spent a fair amount of time discussing this, and there are limitations on what one can do. DFC uses the IFC performance standards and guidelines, and so the environmental report is going to be more or less the same as it goes to the entities. What is different in many cases are the mitigants that each of the DFIs impose on the borrower. So, how you deal with that, it's a challenge. More collaboration, more coordination. At the end of the day, and this is sort of writ large, we can step up a little bit. What the private sector is going to need is certainty. The more uncertainty, the harder it is to do the deal. Uncertainty in terms of timeline. How long is it going to take me to get done? How long is it going to get me to take through? What is the policy? All those uncertainties make it much harder for DFC to fulfill its policy mandate, which is to close the infrastructure gap. So it's that big highline item that sort of drives the conversation.
Thank you. And Tara, let me wrap this up with you in terms of compensation.
The most popular topic.
The most popular topic.
Well, this is like rapid fire. My understanding, and I'm not a specialist in government comp, is that there's a variety of ways that they can pick the speed you're on, what you get paid, different agencies. I think the SEC is an example of an agency that pays on a higher scale. But the practical reality is if you work at one of these agencies, DFC, you need to be highly trained, very sophisticated. You've spent a lot of money on law school. You've paid your dues at a big law firm somewhere. They just need to compensate them as well as they can for government service. But I don't think people appreciate the level of sophistication. It's not a job that lends itself to hiring law students at a law school. Grab your tissues. A big law firm just announced a new pay scale for 24. A first-year associate will under their pay scale. Sidley has not adopted it yet. Well, you know how big law firms pay. $225 for a first year, and moving up to $425 for a senior associate. So that's what the associate classes get paid in big law. That's the base salary. The bonuses, which are paid based on years out of school and hitting an hour requirement at most firms, is $15,000 to $115,000. So think about it. So, a senior associate's going to end up in the mid-500s if they're in good standing and they're working hard. So we're not suggesting that, government's going to pay the same as big law, but there has to be an appreciation for that delta because, remember, a place like DFC is not hiring first, second, third year, fourth years, right? Their sweet spot is probably like a fifth or a sixth year, or more senior if they can get it. But it's just very competitive. So it's just there's just a point where you just have to kind of look in the couch for as much money as you can get to get the best talent.
Yeah, and this is true not just for lawyers, but also for the finance professionals.
Yeah,
Almost all of whom have MBAs from the top schools, et cetera. And you heard the numbers that Tara used for law firms. Obviously, I don't know that our Morgan Stanley people and whatever are still here, but I'm pretty sure that those numbers are not small. But just for perspective, the top salary for career at DFC is $183,000.
Right.
At SEC, somebody with 4 years of experience can get paid $289,000. So that's what we're talking about. Allow this other schedule more flexibility that has to be a congressional act to apply to DFC so that they can not meet that. It's never going to happen, but at least be a bit more reasonable.
Well, seems like I made the wrong career choice, but thank you. Thank you to our panelists. I know. I have some soul searching to do later tonight.
You can do some secretary certificate.
But thank you all very much for sticking with us throughout this afternoon. Again, I want to thank our leader, Dr. Sadek Wahba, who's with us today. Thank you, Sadek, for being here. And with that, I'll turn it over back to you, Mark. Thanks.
Let's have a round of applause for our panel here. Wow, we have really gotten a lot of great insights, a lot of great conversation, a lot of wonderful ideas. And although our panel comes to an end, our time together comes to an end here, our work just is beginning at the Wahba Institute for Strategic Competition, because the challenge we face is that this is complicated, difficult to understand stuff. And we need to break it down into specific policy recommendations that we can take and have members of Congress, their staff, administration move forward on. That's what we've been doing. We've been actively engaging Congress in this effort, and we'll continue to do so. And so what I really like about this is we have it all on tape. I once upon a time used to be those finance persons, and I understood this all. Now I can watch it all and try to distill it and make sure we can communicate it to those policymakers that are going to change. So I'm deeply appreciative of all the work that the study groups, the working groups did to bring these recommendations. Appreciative of everybody, all the panelists here today, the Wilson Center people that helped make this happen. Appreciative of all the good support we've had from people like our chairman, Sadek Wahba, and we're going to take this and move it forward. I would say it's important because when you think about what infrastructure investment around the world does in terms of enhancing people's lives and what they have in front of them, but also what that does to raise the American flag in those countries and help us in so many ways. It's a win-win situation that we need to do dramatically more of than we're doing today. But in the current moment, our task is to go down to the fourth floor where we have receptions and some beverages and entree or little snacks. We want to appreciate you for taking the time with us on this journey and look forward to you continuing to join us in this journey in the months and years ahead as we bring more private investment in international infrastructure around the world. Thank you all.